Karen Feinerman, Dan Nathan, Guy Adami, and Jeff Mills. And we start off with the China plunge heard round the world. The K-Web Chinese Internet ETF dropping more than 13% to an all-time low, putting in its worst day since it started trading 9 years ago. It is now down 80% from the record high hit just last year. The China large-cap ETF, the FXI, dropped over 9%, is on pace for its worst month since September 2011. Among the biggest losers in the region, Pinduoduo, online recruiting company Kanzhun, and fintech firm 360 Digitech, tech stalwart Alibaba, dropping 12.5%, touching its lowest level since IPOing in 2014. But it wasn't just companies based in China that got hit. Starbucks, which counts China as its second biggest operating region, dropped more than 5%. Las Vegas Sands, down more than 10%. Yum China, down nearly 14%. All this after China's President Xi Jinping locked in an unprecedented third term in office. The win sparking fears that his policies could hamper growth of private firms and make the country uninvestable. We've got live reaction now from our Eunice Yoon, who's on the ground in Beijing. Good early Tuesday morning, Eunice.
Hi, Melissa. Well, President Xi, as you said, secured a third five-year term, so that much was expected. But the scale of his political victory has made him the most commanding leader since the regime's founder, Chairman Mao. At the end of the week-long Communist Party Congress, President Xi revealed his leadership team. The elite group was packed with Xi's allies and supporters, which suggests that President Xi is going to have a total control over the direction of China. Now, that essentially means that we're going to see a continuation of zero COVID controls, state-led economic policies, as well as a more hostile stance towards the U.S. In fact, a state news agency, Xinhua, said that she personally vetted the leadership team with one of the criteria as a fitness to fight the West. President Xi's dominance seemed to result in a flex move against one of his predecessors, ex-President Hu Jintao, was very unceremoniously and abruptly removed from the Congress towards the end. And that has been sending a signal to many that China has entered a new era where President Xi reigns supreme. Melissa?
You mentioned signaling a new era, Eunice, but the truth is not many people in China are even aware that Hu Jintao was escorted out in any fashion.
Yeah, that's right. There are a lot of people who are aware, but they speak about it only privately. It's been completely vetted on social media. And in terms of the actual reporting, the official media has not been talking about it at all. There was one state media reporter who tweeted, so in English to a foreign audience, that perhaps he had health issues. But there is some conversation going on, and one way that people are trying to talk about it publicly, or at least show their sympathy, is that they're posting a photo of his empty chair.
Eunice, thank you. Eunice Yoon in Beijing. There are a lot of levels to this in terms of the fears, the impact on U.S. stocks, on stocks in China, on the economy here. One is a zero COVID policy. The number 2 guy in the Politburo was in charge of the 2-month lockdown in Shanghai. He's not backing away. He's going to be supporting this policy for sure. And then also the crackdown on the tech sector and entrepreneurs and capitalism at large in China.
First of all, welcome back. It's great to have you back. Eunice is amazing. It's 4 in the morning and she's still working. Good for her. In terms of the stock market, yeah, I mean, this to me is extraordinarily bearish for what's going on here. Now, full disclosure, I remain bullish in the short term. We talked about that a week and a half ago, how this situation set up the same way it did back in the middle of June when the market proceeded to rally almost 19% into the middle of August. I think we're up 8% since the lows. I think we have another 6-7%. Then you sell it again, and I think that will happen post-election. But in terms of this story specifically, yeah, it has far-reaching ramifications. However, quickly on a trade, and we talked about this. What's that holiday around the 4th of July here in the United States?
4th of July.
It's odd that they call it that. But anyway, you go back and look what happened to Alibaba around the 4th of July. Stock rallied almost 50%. We actually talked about it leading up to it. I think you have another situation where it's setting up for a trade. Traded 5 times normal volume today, made a low we haven't seen in 6 years, to your earlier point. I think you can trade Baba from the long side into earnings next week, Melms.
So I thought there was a lot to hate about what came out, right? I think the expectations were that it was going to be bad, and I think it sort of exceeded those expectations. I mean, you got so many levels. You've got China's economy just on its own, right? Forgetting all the noise around it, right? This is a very different China than the high growth days that we're used to. So that's one. Then you've got all the ramifications of, him being in total control now, him being playing really hardball against the U.S. We haven't really seen that as it's as tough as it's going to be. We're at the beginning of that. So there's that. And then there's just if anyone were hopeful that maybe it would be different, there's that selling as well. So you put all that together. For me, in the short term, it does make China uninvestable. I know if Tim were here, he would say, you make the most money when things go from terrible to just really bad. We're in terrible right now. I would agree with him there. I don't know that we're yet ready for really bad.
For a trade, though, Dan.
Yeah. I mean, when we talk, we get asked this question all the time. It's like, what is capitulation? What are the kind of components and the inputs of capitulation? I think you have an event like this. We all expected, like you just said, it was not going to be great news. And then you have this sort of market reaction to it. That sort of gap. I was looking at the FXI. That's the iShares Large Cap China ETF. These are Hong Kong listed names in that ETF. Alibaba, the name the guy just mentioned, is one of the top holdings. Tencent, Baidu, Meituan. I mean, like big names, You can buy that thing down 35, 40% on the year, down a lot more from its all-time highs. I took a shot right on the close here. I'm starting to pick at that. Looking at calls out in December, I mean, the calls that I bought, the December 22s, they're about 4.5% the price of the ETF. You think about how this thing is moving around and how much is down. Again, I think it's probably uninvestable long-term, but I think both of you guys are saying it's tradable right here.
Well, that's a really good risk. We were talking about that in the green room, right? Yeah. One day of euphoria, which could absolutely happen, and that's an interesting trade, and you know exactly what you're going to lose. You don't need to worry about, do I sell it now? I'm down. Right.
Jeff?
Yeah, I mean, look, it's still a massive economy with some growth potential there, but we've been thinking about investing in emerging markets differently just because a lot of people will go out and buy the ETF, EEM, for example, and what do you get? You get a 50% slug of passive China exposure, and I don't know that's what you want right now. I think you have to be a little bit more selective. I think you have to have managers that really know the landscape there and can pick the companies that are maybe a little bit less vulnerable to some of the stuff we're talking about here. But we keep talking about the potential for S&P 500 earnings expectations to come down. So for multinationals, the strong dollar has been bad. This is bad. 7% of S&P 500 earnings come from China. So, we talked about it. The likes of Starbucks, Nike, Apple, Qualcomm, semis. We've talked about casinos in the past. Do you want to own something like Wynn, which is really a binary play on China reopening? Or would you rather own something like an MGM? I think you have to be thoughtful and understand where the revenue exposure is coming from in this environment and really going forward, because I don't think this is going to change. The last thing I'll say is, everybody's very focused on KWeb for obvious reasons. It's very interesting if you look at the way it's been trading. It's been trading with high beta. Of course, those companies have specific issues, but if you look at the correlation, KWeb, ARK, for example, it's 0.75. So this is trading with the high beta trade of this market. ARK's correlation with the S&P 500 is like 0.4. So I think you have these issues that are going to weigh on those stocks, plus the idea that investors are just going to be risk averse here going forward. That's how those stocks have traded. Of course, you could trade it for a pop. I think that's very possible. But thinking out, a couple of quarters, it's a difficult place to be right now.